Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade, episode number 118 for St. Patrick's Day, March 17th, 2020. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today we will be discussing your trade ideas. So over the last few days, about 40 people submitted up to 5 symbols each, and we're going to go through that list and get through as many as we can today and talk about all the other exciting things going on in the market right now. So we are broadcasting and recording this at 4 p.m. Eastern time. And today I have arranged for Mike Pisani of Smart Option Trading and the Option Professor of OptionProfessor.com to join us. So Jim is moderating. Jim of Option Professor is moderating, and I'm going to go ahead and turn it over to him.
Okay, thanks, David, and welcome everybody here. Mike Pisani is here for us today. Before we get started, let's introduce Mike for people who are uninformed of Mike, and a little background on what you're doing down there at your firm.
Hey, thanks, Jim. Thanks, David. Always great to be on this show. Love it. I've been trading since just after the financial crisis. We just started to look at the outside, and that's when I started paying attention to the market. So this is my second crisis I'm dealing with, so this is kind of cool. I focus on technicals and options flow and volume when I do my trading. I have a trading room that I have up, which I'll tell you about later on. And basically, it depends upon the market. I'd rather swing trade, but in this market, I'm surgical, Jim. I'm in and out. I may be in a trade for 3 seconds. I don't care how long it takes. I'm in and out. I'm not screwing around with this money or 3 minutes. You know, put money in your pocket and move on to the next trade.
Yeah, there's a lot of volatility, so obviously there's a lot of action, and again, quantifying and trying to limit the risk is obviously key, so you can fight another day in case something doesn't go your way, because opportunity with this kind of volatility is constantly in your face.
As soon as I get green, I move my stop in the money, and if I get stopped out for 3 cents or a 50-cent gain on whatever as I'm trading, it's fine. I just keep walking it up because I can always get back in.
Yeah, there's no question about it. And that's a big thing to remember is you can always get back in, because a lot of people, when the market was very high, they were concerned that, they weren't going to get another chance and this and that and the other. And all they really had to do was get out and or hedge or do something. And then, of course, if they were wrong, which they wouldn't have been, but if they were wrong, they could have come back in once the market proved it could get above certain levels. Yep. All right, people want to probably hear a little bit about the macro background. So without further ado, Mike, what's your macro view right now as far as where we're at now, and some of your best guesses on what might be happening?
Thanks, Jim. So first of all, I was in a lot of cash before the market broke down. This was back up here as we went into February, as I thought the market was just getting to that ludicrous point where it just kept moving and that just felt uneasy. I didn't see this coming. I'll be the first to tell you, I did not see this type of move coming down, and I would never take credit for it. But I was in a good position when it came. We've broken every level. Nothing's held. If you look at Fibonacci's, everything has been broken down here. And here we are, we came down and the 2018 lows are at 233 and we're just off of it today. We just missed it. We had this big candle today, but it didn't really feel all that great. And the one thing I advise everybody here is try not to look and call a bottom. The bottom is going to present itself. In a market like this, the chances of us getting a V bottom back to all-time highs are slim. Chances are we're going to get a vicious bounce when we start to come out of this, and then we're going to bounce around for a while. My screen is up.
Hey, yeah, Mike, we're just seeing your email right now.
Oh, did I put the wrong screen on? I'm so sorry. Mm-hmm. Hang on, let me redo it. That didn't help. Let me reshare. Trying to reshare here. I can't find my, there it is. It's because it's in the middle of nowhere. Oh, you guys use a different number than I'm used to using in my Zoom. Sorry for screen monitors. Can you see my screen now?
Yep, we see it now.
Thank you. You can see my email. So for me is, if we can't hold this 237 area, and I don't really feel like it will hold, I think you look at 233, which is 2018 lows. Then you look down at the 219 area, then 212, and then lastly is 2000. Really, this market will turn when really it's a medical problem, I think, Jim. And when we see the curve start to go down across the world, the United States and Europe, I think that's going to ignite the turn. And you got so much money and liquidity being pumped into this market, $1 trillion a day now in repos from the Fed. When this market turns, the bounce is going to be vicious for the short term.
Yeah, there's a couple of things I was going to ask you is, with a move from 667 up to 3,400 was about a 2,734 point move. So
Yep.
about a 40% drop takes us to about where the lows have been already in that 2,300 neighborhood. And then a 50% drop gets you to 2,000 and a 60% drop gets you down to 1,700. Do you have any gut feelings which one of those levels might be the most reasonable, or is it just ridiculous to guess because these earnings are going to fall off a cliff and the GDP is going to fall off a cliff? And, Adidas lost 85% of their revenue over in China when they were having their problem. So, these numbers that are going to come out are unknowable.
I think really trying to pick a level is useless in a market. This market's not trading on technicals at this point. It's trading on fear, right?
Mm-hmm.
And we haven't seen, most people who trade now haven't seen this.
Mm-hmm.
They don't know how to trade this. So the way you trade this is the market will tell you when the bottom's in. And for me, you're right. It could be 40, could be 60%, but you let the bottom show itself, and the bottom will show itself. And it'll show itself before everything turns. If I really believe if we stepped in and we locked this country down today, the market would start to rally because it would know that we're doing everything to accelerate the end of this. Does that make sense?
Yeah, I mean, I think stabilizing this transportation average is obviously very key because the transports and the Russell gave you the indications that the rally was a baloney rally, and now they really have gone down to like 2016 levels where the stock market on the S&P hasn't. So I don't know, the Russell and the transports, if they were to stabilize and the Treasury market were to stabilize, I think the confidence, and then of course, if you got the cases rolling over, that would be the trifecta, really.
Yeah, it really would. And again, there's so much liquidity being pumped in around the world.
I'll tell you, one of the reasons they're pumping liquidity in is obviously short-term paper is very, very volatile. Today, I was pricing out J.P. Morgan and HSBC Bank and a couple of other ones, and you can get one-year paper at over 3% at some of the money center banks, and that's a pretty good rate for a one-year instrument. It's a senior unsecured debt, but I mean, that's telling me, and the bid is 92 and the ask is 98. So there's some liquidity issues definitely in short-term paper on the corporate side. And, they're down, or they're in the process of downgrading, I think, Delta now, and also, I think, Boeing. So,
Yep.
there's definitely some winds of change. It's no joke.
There definitely is. I think you have to look, though, at companies that are going to come out of this okay. And, I keep saying Apple because Apple has the cash to survive this. And even with their stores closed, people are still going to go, their business model is not going to change. People who want Apple's phones are going to buy Apple phones when this is over.
Mm-hmm.
Right? So you look at companies like that. You look at companies like software companies that are still going to have their service because everything's going to ramp back up. Microsoft, you saw Coop with good earnings today. You look at companies that can get hit like Boeing. I don't know where the bottom is for Boeing, Jim.
Mm-hmm.
I really don't. And that company's just been, what a horrible year. The last year has just been horrible for them.
So your gut feeling is the companies with big cash, like Apple, Amazon, Microsoft, and Google, obviously would be one of the places to kind of start chipping away at.
Those are places I would run to when this starts to look like we're turning. I think they're going to be the strongest. They've also been some of the strongest charts out there, holding in better than most in the markets. And that's, I think, what you look at.
What about the semis like NVIDIA and things like that?
Their story doesn't change either. I think AMD, NVIDIA, Micron, these are all screaming buys when this is over. Their story hasn't changed, right? They may see a slowdown at first, but at the end of the day, we all are a online, we're using chips in everything world. This is going to go right back up again.
Right. And those are the ones that'll probably, in your view, be snapping back the most, as opposed to the Boeings and some of the transports, which, since they're getting support payments to survive, they may not snap back quite as fast, right?
They'll have a snapback, but they may be stuck. Also, people talking about the airlines and the cruise ships and the hotels. People are not going to run right back into that lifestyle, right?
Mm-hmm.
they're going to
I don't think so.
they're going to be a little bit more conservative. They may take a little while to bounce back. So yeah, I think you stick with names where there's going to be an instant use, where businesses especially are going to go right back to. And you be careful with names like Zoom. I love Zoom. I use Zoom. We're using Zoom. But eventually that thing's going to deflate.
Mm-hmm. Yeah, it's being bid up. Just like the food stores like Kroger are getting bid up a little bit too high.
Because, if panic.
Yeah.
So, somebody's asking, why are we going down if market's forward looking? Because it's fear, it's panic, it's the unknown. The market wants unknown. Right now, we have a big unknown event. And when you have unknown, the market gets nervous. And that's where we're at now.
With regards to one that everyone always talks about, or two of them actually, the banks. Some of them snapped back pretty good today, and some of them didn't. I think Bank of America snapped back pretty good, and Wells and J.P. Morgan, but Citi didn't seem to get much of a bid, even though it's trading supposedly $20 under tangible book.
So for me, if you want to trade the banks, you take J.P. Morgan right now. They're still best in breed. I've been saying this every time I go on someplace. That's not because I own it or I'm a fan of it. I just think it's the best managed bank out there. With interest rates at zero, most of these banks, they're in trouble with that, right? They can't make money. So it's the banks that trade well and trade the volatility well. So I'd look at J.P. Morgan, I'd look at Morgan Stanley. Goldman Sachs, for whatever reason, has been holding in better. And these are the banks that have bigger trading floors, and that's where their revenue has to come from right now, because we're back to a 0% interest environment.
The valuation model on J.P. Morgan is a little bit lower, though. The tangible book supposedly around 60. But if it's best of breed, there's no reason that it couldn't continue to trade at a premium, because it's always traded at a premium, right?
It has, and their P&E is down to about 7, right?
Yeah.
So I mean, there's nothing scary there. That's not a scary number.
No. You just don't know. There's some unknowns out there. There's always two sides of the coin. Obviously, they're a big bank, and their reserves supposedly are much, much greater than they were before. And, they have got good backing by the government. So it looks like things will be fine. On the other side, they've got to have loans out there that may not get paid on. And they've got other factors out there, it seems like.
You want to avoid banks that have huge exposure to the U.S. shale market.
Right.
Because they're going to get killed. Those loans what's going on in oil, and if you guys aren't paying attention to oil, we're going lower. Unless these guys sit down and talk again, Saudi is now producing a record amount of oil per day. So is Russia. They're out.
They said through May, I think, Mike. I think they said through May.
Yeah. So, this is game on, and this is going to, all these U.S. Shale oil companies, they're dead. They're heavily indebted, and now they're in real trouble. So you want to look at your banks. There's some links out there that'll tell you who has the most exposure. Avoid them, because you're going to see a lot of bankruptcies. And the retail, the retailers, you're going to see big time bankruptcies when this is over.
Yeah, because foot traffic is not going to be viewed very positively. Once you get away from foot traffic, you probably don't run right back to it.
Not only that, Jim, who's still open? Macy's just is closing. Everybody's closing all their stores.
Right. And Kohl's and people like that.
Yeah.
Well, you want to hit the list?
Let's do it. Let's have some fun. By the way, I see you have UPS up. So FedEx just came out with earnings.
Oh, what happened?
Nice beat. Popped up about about $10, and now slowly giving it all back.
Yeah, because it's backward looking, right?
Yeah.
But it had a good day today beforehand. It was up about 5% today. So
yeah.
But anyway, your feeling on FedEx, looking at the graph here, I guess we hit a 52-week low at about $88.
Yeah, UPS.
Yeah, no, I'm sorry. I was on
which
FedEx.
One do you want to do?
Yeah, because I had switched screens. No, UPS, it had a 52-week low of about 80 something, right?
82.
82, right. Okay. So is that a good line in the sand if you wanted to buy and defend, or what do you think?
Well, look at today's candle. That was a monstrous candle. I think part of that came from Amazon's announcement that, they're hiring 100,000 people. They're going to keep delivering. I think Amazon is positioning themselves as the company that's going to keep delivering food and supplies to this country if we do go on lockdown. So the UPS will also be involved in that. I think 82 is a great buy, obviously. Look how far it is off of it now. these are tough. I mean, if you watch this, if this starts to bounce, you have this gap up here at 100, and it can go. You know, it's hard for me to say buy any company here. If you want to nibble, I think nibbling's good, right? I wouldn't be buying options on names here for long-term holds yet.
Yeah, those lines above, the green, purple, and the gray, or whatever the colors they are in the green, I guess you have the Okeechobee cloud or whatever. Yeah.
That's the Bollinger Bands.
Okay, so I mean, all of that stuff is very ominous over the market.
Well, you got the 50-day moving average in purple. You have the 100-day moving average in gray, and you have the 200-day in green. So, you know, to your point, we're well below. Look how far we are below the 200-day here.
Yeah.
Right. You know, so you're getting a snapback rally on a good day, and this name outperformed today.
But the rivers are all pointing south.
Yeah, in my opinion,
and
you know,
that's a problem.
I'm not buying anything long term yet. I am being
you.
patient. I think the market will show itself when it's ready, and I'd rather wait than start. But if you want to nibble, if you'd buy 1,000 shares of it, I'd buy 100 or 200. I wouldn't buy a full size.
Right. And that 82, you know, does look like a nice spike bottom there. And if it got taken out, it'd probably coordinate with that 2000 S&P number.
Well, I think something, and I think the other thing is you start doing here is you have to, and I've been doing this for a lot now, is going to weekly charts.
Yeah, exactly. You need a larger range.
Right. So you need to get out of the 1 year range, and you look at this 82 area. Oops. Sorry, I did not switch to what I wanted. There we go. So you look at this 82 area and you say, okay, well, where did this line up with? Well, look at that. Look at all the support it had back here from 4 to 5 years ago.
Right.
And right into that, and it held it. So that's nice. So that tells you it has strong support there.
Right.
And
the
so,
2016 time frame, which also corresponds to about 1,800 to 2,200 on the S&P as far as a window during that time frame. I don't think is a bad time frame to look at as far as a potential low area, because the transports went into that neighborhood, the Russell went into that neighborhood, and so European markets have gone into that neighborhood. So I think when you get to, if you look at a long-term graph on any of these stocks, and you can see them somewhere around the 2016 area, and we're not going to fall off the cliff, that could be a neighborhood, because obviously oil has blown through that, and oil's back to where long-term capital management and the dot-com bust happened. So, you know, the Exxons and the Chevrons have really been discounted. But I think realistically, you should be willing to grit your teeth through the 2016 price zone.
I think you have to, and I think that's where you start looking at it. I think that's the areas you start saying, okay, is this an area where I want to buy? But, you know, I wouldn't chase stuff here.
No, but you know, like if you went into that zone, which you did when you're at 82 on UPS, you know, and then you wanted to start putting on a percentage of what your wish list is, I think obviously that would have made a lot of sense. And if you know, if you have other stocks that we're looking at, you know, if we get into that zone of the 2016 numbers and you wanted to put your toe in the water, that would be a reasonable spot to consider.
Yeah, and again, if you like the transports, and then, you know, we'll see what, you know, also watch what FedEx does after tonight. But also look on the volume profile. Look at the amount of volume. I put this 5-year chart up. I put the volume profile on the left here for us.
Yeah.
Look at the volume. Look at the big volume area it came into.
Oh yeah.
You know, so if it doesn't hold there, there's no support below here.
No, that's why I'm saying if you were going to, you know, start a tiptoe deal, that 80 to 85 area seemed to be a neighborhood. And again, you have to expect the volume to be huge because, again, you know, companies are not even making any money. And the PE ratio is just impossible to figure. And so ergo, they have a very difficult time valuating companies when the E on the PE is been thrown out the window.
And we really don't know, because until we get into next earnings season, then we'll start getting an idea what the damage is.
Yeah, because right now it is blind man's bluff as far as trying to evaluate a company.
Yeah, I agree.
All right, well, the next guy on the list here is Adobe, and this is one, obviously all of them were gliding free until last month, and then this thing gave it up pretty hard like everything else. But today, again, up 10%, so it shows you some legs when it wants to turn. Where is it versus the 2016 numbers, though?
Oh, let's pull it up here. So first of all, Cooper reported earnings last night. They were really good. And, you know, so that's another name in their sector. You look on a weekly chart. I mean, this is what you're looking for. These are the names you guys want to be looking at. Look at the weekly chart. This name barely came back to where it broke out from, right? Touched it and bounced right off of it. right into this volume zone, right? Well above 2016, not even close down to this area.
Right.
On the weekly chart. And you take it back to a daily chart, yeah, that's a nasty steep fall. But look at this, already reclaimed the 200-day. The QQQs are under the 200-day. This reclaimed it. It's showing relative strength. And this is what you want to look for, names that are showing relative strength. Software names are likely to come screaming back because companies need their software. They're going to continue to use it.
Yeah, that's the theme that I'm hearing is that, the 5G and the cybersecurity and all those kind of things, they're not negotiable.
Yeah, you have to have them, and yep, they may not be buying new stuff today, right?
Right.
But doesn't mean that they're not going. As soon as this is over, they'll start buying.
Yeah, people are very hesitant to throw out the gold nuggets, and this is one of them. But again, of course, it did did have a big drop down to 256, I guess, right?
It had a huge drop down here, right?
So,
it came down into this area. Now this recent pull came all the way down here to 278 today. That's what it reversed off of. Beautiful reversal candle off of there today, right?
mm-hmm.
Engulfed the previous day's candle, engulfed this little area. Again, you look at it on a weekly chart. This thing's showing incredible strength. This is what you want to be in. This is what you want to be looking at, especially if it manages to take out this 315 area.
Mm-hmm.
Right? 315 gets over that, this thing can run. If the market runs, this is a name I would be looking at. Look where it stopped today. Oh, look at that, right just into that 314, 315 area, right where that previous high is, right in here.
What about that SMH?
The semis?
Mm-hmm.
Man, tough market for these guys. A lot of these companies' production was dead because they get everything out of China for a while.
Mm-hmm. But
I suspect they bounce back. You've had this huge pullback in here. You look at it come down here, it came all the way into the 100 area.
Mm-hmm.
Massive pull from 152, right? $50. It just gave you this thing just gave you a 1/3 discount, 33% discount. And that's what I keep telling everybody. If you liked it up here, don't tell me you don't like it down here.
Yeah.
Doesn't mean buy it today, but you should be looking at it here. And you look at this on the long term.
Well, this thing, if this, like on the semis, if this thing was going to come down to the 2018 December price, that's 80. And if it's going to come down to the 2016 price, that's 60. And I think to get to those other numbers, you're going to have to see that 2350 on the S&P break.
You are, because look what it did today. It came into this massive volume area this week, right?
Yeah.
And it's holding in there. It held right into that.
Mm.
So again, are people going to stop buying computers and gadgets and stuff? No. Are they buying them today? Probably not. But I'd rather go into this than into cars. Anything big purchase. I mean, who's going to buy a Tesla or a new car right now?
Well, the one thing that would be is with interest rates this low, you would imagine lease rates would be very low.
Sure. But who wants to take the chance in the next month to 2 months?
Oh, not in the next month. No.
Yeah.
I mean, obviously, it seems like the whole world's on ice through the end of April. And then basically, hopefully, the sun will start coming out when it's supposed to come out, which is spring. And hopefully, again, a lot of times with the markets, because I've been in it for obviously more than I want to admit, they do try to get all the blood on the street as fast as possible for, in my view, two reasons. One is to trap the people in there so they don't have to worry about more selling because everyone's going to throw up their arms and going too late to sell. Secondly, the restructuring of the recovery can start faster if you get all the blood on the street. So whether it be the 87 crash or the .com or the 08, you'll notice that it's a precipitous drop as fast as possible, and then the rebuilding can start. So I think, by the end of even March into April, it wouldn't surprise me if most of the carnage is behind us.
Well, because the market is, again, it's a sucker punch, right?
Mm-hmm.
One thing that I keep hearing is some of these funds haven't sold their positions.
Right.
They're waiting. They knew this was coming, but they're not selling because they think it's going to come back. Now, again, I don't think we're getting back to all-time highs this year at this point. That's been my change. Where I thought the high for the year wasn't in a month ago.
Mm-hmm.
At this point, I think the high for the year is in. I'd be shocked if we got back to the all-time high this year.
I had heard on TV that Goldman is making a call for 3,200 by the end of the year. I hope that
Goldman also said that this country was recession-proof about a month ago.
I just hope Hank Paulson's giving him the information.
When I heard that, Jim, I was like, okay, we're in trouble. I remember saying that when anybody starts talking like that, you're in trouble.
You heard it too, right?
Yeah.
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 I think really Goldman is not what they used to be.
Yeah. Yeah.
So,
Well, anyway, let's move to another one that everyone obviously is very well aware of, and certainly is a lot lower priced at 146 than it is at 190. Microsoft.
this is one of the companies I would focus on when we come out of this. It's had a big pullback. It had almost, got up to 190. It's back down here at 135 today. Look at the beautiful bounce today, touched the 200-day. Look where it held, Jim. Amazing that. It held that volume profile, this big consolidation range, right?
Mm-hmm.
And you can see this on the yearly chart. Look at the consolidation it did in here before exploding out. It's all about for them is their cloud, and their cloud is going through the roof.
Absolutely.
There's some question over the Jedi contract, but I like this name. I think this is a name that's well positioned to come out of this. And again, look at it on the weekly chart. They, like Adobe, they've barely given anything back.
Yeah. If we are going to return to a normal later this year or next year, the Microsofts, the Amazons, and the other Apples, you would think that they would be a big part of it because of the cloud, because of the 5G, because of the cybersecurity, and all those other things that people use, right?
Again, companies will be buying this stuff. It's not retail.
Yeah, exactly. Here's one that seems like it's under some duress, as everything is, but oh no, this isn't what I was looking different. Anyway, CRWD is CrowdStrike, is it?
So I am long this. I own it up at 67. I'm in a lot of pain. I sold a bunch of calls against it, which helped me out. But they have earnings this week. This is a cybersecurity company. I kind of decided to hold it, and it was a mistake at that point. I should have just taken a loss. But I like their story. I like what they're doing. We'll see what's. I think they have earnings tomorrow night or Thursday night. I'll see what they do from here. It's a long-term hold for me, Jim. So I'm not.
Yeah.
You don't see me stressing over it. You don't see me, saying this. But we'll see what happens here. The nice little bounce back today. But honestly, at this point, they need to reclaim up into this 44 area, and then maybe they start to rebuild. We'll see what earnings brings. But again, at the end of the day, when the market comes out of this, I think this is a good name. In this space, they're doing things others aren't doing. They're better than most of the other cybersecurity companies out there right now. But it may take months before this thing starts to recover, and just be aware of that.
Yeah, and the problem also is it has not been public all that long, and so most of the people who got in were probably speculating, and also were very much intrigued when it ran up to 100. And
made a lot of money going to 100.
And then you got a lot of people who own the stock on the offering, and so they want to grab as much money as they can. So you had a lot of people who wanted to grab the money from the offering, and maybe those people are now gone a lot, and so now maybe you're left with people like yourself who actually believe in the company.
Yeah, and again, you got to take it back level by level.
Yeah.
And for me here, if it starts to creep up, I'll probably sell. And if the market looks weak, I'll sell some calls against it again. But right now the big area is 46. It's got to reclaim 46, because it reclaims that, then it takes back this previous low, and if it can hold above there, then it starts to rebuild. But you have earnings this week, so I wouldn't tell anybody to buy it ahead of earnings, because I don't know what to expect.
Oh, I'd love to hear your point on this, because something that I've heard is that Google and Facebook obviously make a lot of money off of ads. Mm-hmm. And there is some concern that the advertising market is going to obviously hit the skids, because not people want to advertise to come to my restaurant that's now locked up. So anyway, do you think that there is vulnerability in Facebook? Well, we're going to look at Facebook, but do you think in both companies? Obviously, Google has more money than they know what to do with, so they're
very diverse.
Yeah, and they do have the other stuff too. But do you think Facebook could be damaged by a pullback in ad sales, or do you think this is just temporary and it's going to be back up?
You would think when everybody starts staying home, they're going to be on social media all day long. Mm-hmm. I think your small advertiser, they're in trouble. I think the big guys they're going to double down, right? One thing I've learned in my years is that when companies have problems, the first thing they do is they double down on sales and advertising. Okay. To try to get things going. But the little guys, to your point, they're not going to be advertising.
Right.
Now, let's remember, Facebook had horrific earnings. Facebook is not down here just because of what's going on. Facebook was horrible this quarter, right? Mm-hmm. They had bad earnings. That's that big gap down you see sitting up here. down to the 200 area, and they've been punished because of it. And honestly, I really believe they're a very badly managed company at this point, Jim. They have a great product between Facebook and Instagram and WhatsApp, and they're just not well managed. They have all these security problems. They let all these fake news articles goes up all over the place. Not easy to control, but
Yeah.
I think they need better management. I think Jack at Twitter does a much better job with this. Twitter just seems to do a better job at coping with this than they do.
What do you, if you widen this out to 2 years, do you think there's a potential to go down to that 2016 levels between 100 and 125? And would that be a neighborhood of more value?
I think I would actually be a buyer again at 123 area, that 125 area.
Yeah.
I do think there's potential to go down there because I think this is one of the names that it's just off, right? They just pick companies, people don't trust Facebook.
Right.
And I think that's what it comes down to. I mean, nobody trusts Zuckerberg. They don't trust that company.
Just his eyes, when you look at him, he just doesn't, you don't know if he's, what he's doing now.
You watch Saturday Night Live at all?
Yeah, sometimes, yeah.
You see where they have Zuckerberg making fun of him? They have him sitting there giggling, like horror.
Yeah. I mean, that, and those parodies are funny because there's a grain of truth to them. Right?
Exactly.
Yeah.
So I think that's part of the problem here. But, today it came in, it held here. The other area I'd watch is right around this 133 area. You see where it picks up this previous area from here? And then you have that big volume. Obviously, the big volume is in here down to that 2018 lows. I agree. But, this would not be one of the first names I run screaming for. This is not on my radar. It would if it got down here.
I think the reason there's a difference between the December 2018 lows, which was really more attributed to a slowdown because the Fed was hiking rates, to the 2016, which was really the last legitimate growth scare. I think that's why, like a Geiger counter, most of the markets that have really gone through a more substantial drop have stabilized in the 2016 numbers rather than the 2018 numbers. So that's why, if I'm looking at things, I'd like to give it the rope to 2016 numbers.
That's a long way off, though.
Well, I know, and with the tech sector, but I mean, to be honest with you, the tech sector wasn't breaking, and then obviously they said, hey, listen, we're way above our 200-day moving averages. We are way above the 2018, 2016 numbers. So they have played a little bit of a mean game of catch-up. I mean, Home Depot going down 20% a day, I think, is telling you that people are now saying that we're sparing no people here.
Well, I think that's really part of it, right? This is everybody's going to get hurt. I mean, even Home Depot, how much longer are they going to be able to stay open for? And I think what you have to look here is and say is what do you like? How do you feel about things? Is there anything you want to be in or not? And everything in this market can get hit. And that's the one thing I always tell everybody is in any market, there will always be honey badger stocks for a while, but eventually everything gets hit.
Yeah, and the other tough thing is like I say, we have this hopefully temporary shutdown. And so, how do you evaluate the companies? Because if you went with a PE ratio, these prices could go substantially lower. But I think there's going to be some kind of a pass given for the first couple of quarters. And then, so they're not going to hit them maybe quite as hard as they would. Because I saw Adidas stock, because I'm using Adidas as a reference because I saw an interview with the CEO who said he lost 85% of his revenue or 90% of his revenue during the Q1 where the Chinese thing was hitting hard. But he also said that when people come back out of the house, they don't run down and get their athletic shoes first thing they do.
No.
So. He was kind of like saying, I'm hoping things are stabilizing, but he did admit to the whack that he took. And so I think there's a significant whack that's going to come out with those numbers. And I think
I think it's kind of built in at this point. You think
it's fully discounted?
Look at the price levels we're seeing on these names. I mean, I think they're going to accept that this is part of it. I mean, every company's coming out warning, right? Retracting guidance. Every company under the sun is coming out, retracting guidance. I mean, this is a given. This is built in at this point, Jim. When this is done, they're going to look and say, okay, show me your forward guidance. That's what's going to be the most important thing to look. Don't look at earnings when they come out. Look at forward guidance. because
Now,
those will be the
here's the big
companies.
debate on forward guidance is the consumer is 70% of the economy. Is he going to come back out and replicate anything near the spending habits he had 6 months ago? And
Well,
that's the question, right?
that really depends upon how
Yeah.
much problems and debt they go into and how many of them get their jobs back when this is over. And I say that with a very sad look on my face because
Right.
there's a lot of people that are going to hurt big time in this. And, I would encourage everybody, be nice to people.
Right.
Do the little things, help out. There are so many people that are worse off than us who can survive this.
Right.
There are so many people that are just sitting there. I have friends that, they live paycheck to paycheck. They
Yeah.
just lost their job because the business they're in closed. What do?
Yeah. And I have a whole city here in Las Vegas that lives
Yeah.
off tips and stuff like that. So believe me, but it's just started here, so I don't know how it's going to break out. But yeah, it's very disturbing for the hourlies and very disturbing for the tip guys.
The service industry is going to get
The
creamed.
service industry, right? And we are a service economy versus China. That's another reason why the parallels are not quite as good, is because China is a manufacturing economy, and
Exactly.
maybe it's easier to get that started again than it is to get into the service areas. So. Like I say, it's a very unknown. We're trying to navigate it as best we can, and we're trying to use the charts and all technical indicators we can to come up with best guess scenarios.
Agree.
All right, what do we got here next? We're at Tesla. You had mentioned that before. I have no idea about Tesla other than I have some neighbors that have it, and it's a stock that if it was a driver, they'd pull it over for DUI, right? Because it's all over the road.
Well, I mean, you look at this ramp, right, that we had, this move from the 210 to 210 area in a couple months all the way up to 900, which was just ludicrous.
Right.
Right. 971, I think. Where did we go to? Yep. 976.
Yeah.
Ludicrous move, right? Now here we are back at 400 today, where we tagged just below that. I think Musk is a brilliant guy in terms of stuff, but their numbers are going to be atrocious. Nobody in China was buying cars. That was a big part of this ramp up. Nobody here is buying cars. Their numbers are going to be absolutely atrocious as we come into this. I tell people, if you loved it still at 900, here's your discount. But this is not a company I think is really well suited for this type of economy.
Well, you can see why it bounced off the 400 neighborhood, because that was the highs for a very long time.
Yep.
So it did bounce off where it should have. Today, 396 was the low. So I mean, there's no you don't have to be a genius to figure out why it bounced off of the 400 neighborhood, because you had high points through 2017, 2018. 2 years of highs at the 400 mark. So obviously that is your foundation. And now the key is will the foundation hold? But that would be my line in the sand right now for sure.
Yeah. I mean, honestly, as long as it holds that, you want to try it off there, that's great. But you take this aside, I see pain. I don't think this is not a company with deep cash pockets.
That's right. They were always going to the window for debt money, right?
They don't have a lot of cash. They have a lot of expansion going on. They're spending it as fast as they bring it in. This could be a very ugly couple months for them.
And this is the first time we've really seen a situation where maybe some of the devotees have actually gotten out as well.
Well, I mean, if you were buying up in the 900s, you're hurting, and you don't see everybody coming out. Where's the Ron Barons of the world coming out telling us that this thing's going to 1,800 or 2,000, whatever the crazy numbers these guys are throwing out there.
TTD.
Another tough one, Jim. This is such a tough name.
Trade Desk.
These are, this is an advertising, an online, this is like, and the advertising is kind of in a similar Roku in that way, where they specialize in advertising.
Yeah.
And, you look at this on the daily, and this thing's been, what a messy year,
50%
right?
50% off. Yeah.
Yep. Huge move up, 50% discount all the way down to 165. You come back to the weekly chart, and the weekly chart doesn't look nearly as bad, right?
Mm-hmm.
Right. Holding in fairly well. Again, but their whole play is advertising. So you hit upon this earlier. Our advertisers are going to come screaming back in. If they do, this is a great buy. If they don't, this is big trouble.
Shopify, SHOP, had a big burst today. It's come from 600 down to 300, another 50% off deal. Bounced off 300 area very well, I guess, because those were some former highs that we had there. And basically 355 today. And in the aftermarket, looks like it's fading a little bit. But yeah, that 300 number obviously is a number where they'd like it to hold, not unlike Tesla at 400.
Canadian company, Shopify, Canadian Amazon, their earnings were fabulous. You see that big black candle, and they sold off on it. The guidance was great, earnings were great, and they sold off. That was the first warning. Could not take anything back. And it tried to hold in better, and for a while it did hold in a lot better, and it finally capitulated here. To your point, it's coming into an area where it has a little bit of support down here. Again, this thing's had a monstrous move. Remember, Citron was trying to short this thing forever.
Right.
He finally capitulated. But if this thing really wants to come in, if it came to 179, that would probably be a screaming buy on it. If the market capitulates and this thing comes in, 179 area, that would be the spot to look at it.
What do you call it? The next one is AMT, and I believe that's a play on the 5G deal because they have the towers, I guess.
Yep.
And so basically everyone loved that up at 258. And then they threw it out a little bit here down to 188, and now it's 227. You believer in these guys on a long-term basis, but where could you jump on the train here?
I mean, look at today's candle. I mean, this is almost impossible to trade when you see action like if you look at the action here, we went from what, 203 today all the way up to 235 on a company like this, which usually doesn't do much volume. Today it did almost 4.5 million shares.
Yeah.
But again, 5G is going to roll out. The rollout's going to continue. So if you believe in 5G, and I think that's real, this isn't going to stop here. So this is a good one. I think, Verizon's not going to be hurt by this, or AT&T. These guys are going to come back. They're in that right space, right? People are going to move to that eventually.
The next one is called Diamond Eagle, but you're not familiar with that, are you? Or
DEAC, I actually have seen them. I see option flow in this thing every once in a while. This
had
thing is not a name
move.
I would ever trade.
Yeah. It had a good day today. I guess that's why it's on the list.
You look at the move here. I mean, this is,
it hadn't been around very long.
Low float pigs, right?
Yeah.
They have no volume, and then all of a sudden something happens where they get volume. They come in and they start rotating the float, which causes the buy. There's no sellers. It's just rotating the float, and they scream up here, and you get these moves up here, and then they come back down. I don't know enough about this company, Jim, to say I'd ever want anything to do with them, but these are high risk trades. Kind of like all these coronavirus names. Any small biotech that mentions coronavirus, here, let me give you an example. Canfinite, this little biotech on this day. Oh, we're gonna test our drug, our rheumatoid arthritis drug against the coronavirus, and the thing pops $1.
I got you.
Right? I mean, come on.
Yeah.
This is all, play these
Crazy.
at your risk, in my opinion.
All right, let's go over two retailers at one time. One's going to be Costco, and the other one's going to be Amazon. And one of them seems to be more where people go into the store, and the other one, they never go into any store.
Well, I mean, Costco. I mean, you're in Vegas. I can only tell you what happened here in New Jersey on Saturday. I went to my supermarket at 8 o'clock. It was a 90-minute checkout, one line. They had it wrapped, snaked through the supermarket. There was no meat. There was no produce. There was no pasta. There was no anything like that was gone. People were hoarding. So you look at that, and Costco's, they're getting hit like, big buys and stuff as well. So they're doing well. They're getting a pop here. I do wonder what all these people are going to do with all this stuff they bought when they're done. Somebody said they said they're going to return it, and the people looked at them at the Wegmans I go to, like, we're not taking this stuff back.
Exactly. Yeah.
But not a bad place to be. This one, Walmart, Kroger, right?
Yeah.
Holding in near all-time highs. This is where you want to be hanging out. Not far.
Now, what about Amazon here? We're at 1807. Obviously, it's right in there with everything. But the PE ratio is still at 78, and are people going to pay that PE ratio? I think that's one of the problems with Amazon ever since it hit 2100 is that people are not really excited about that PE ratio. The
Jim,
valuation.
It was up $160 today at one point.
Yeah.
Just let that sink in.
Yeah.
They're hiring 100,000 employees right now.
Yeah.
They're positioning themselves to be the company that delivers to this country when nobody can get out.
But are people saying in one way that's all great and they're going to do great and they're going to make a lot of money, but we've already priced that in?
I don't think that's priced in. I look at this company,
but that would be a risk, right?
It would be, but to me, this company, when they reported earnings, that huge move up to 2,000,
Right.
This was the earnings report we haven't had for years out of them.
Right.
And the guidance. And you had this big pop up. They've come in, they're holding in. I think Amazon's well positioned moving forward. I think they're going to get a bigger piece of the market. You come over to a weekly chart, and again, all they've done here is come back into the consolidation area that they've been in for the last couple of years.
Yeah.
You know, look where they held today. They held the previous, look at this little high over here. No coincidence. That's where they came into. They held this big volume area today. I think this is one of the companies that's going to come out of this looking great. Plus, they have all the cloud services. Guess what? Companies are going to be screaming back to the cloud when this is all over. I think this is a safer play. I think for Costco and the Walmarts of the world, this is a short-term pop. And as much as I think Costco is well positioned, don't be fooled by this.
You know, this next one, telephone, I think has been very, very firm in this environment. It pays 6% dividend or better. You got that Elliott Management, involved, I guess, trying to make some shakeups here. What do you think of telephone? It seems like it's holding up pretty good, and you're getting well paid to watch a choppy movie.
Well, I mean, again, do you think people aren't going to buy new cell phones and keep their cell service?
Right.
So, I mean, are they going to upgrade to 5G eventually?
Right.
So, to your point, I think these, this and a Verizon are the safer plays out there. Came in, held the 31 area. You can see on a daily chart, came to this big volume profile area. You come back over here, you can see on a weekly chart, came into this range that it held back in there, another area. Again, I wouldn't be running to buy these today, but I think these are the safer plays. I think these names they're not going to need help. People aren't canceling their cell phone services. They may not be buying new phones, but they're not canceling their services.
A combination of your Microsoft, your Apple, and your Amazons and your Googles, and combining it with some Verizon and telephone, and maybe that tower thing, wouldn't be a bad basket for part of your capital, huh?
No, I mean, I think it's a safer bet than a lot of other areas.
All right, Home Depot got whacked yesterday, and today it is back on the bicycle a little bit, but it did go down as low as 155 from its 247, and that's a good bounce, $25 off the low, almost $20, and fading a little bit in the aftermarket. But what are you thinking here?
I mean, look at the size of this candle today. This thing dropped like a rock to the 155 area.
Yeah,
bounced $20. I mean, when does Home Depot move $20? It doesn't move $20.
No, I was in shock when it was down 20% yesterday.
But here's the problem facing Home Depot is this is their seasonally strong, one of their strongest time of years, right?
Right.
And nobody's going to be doing construction right now.
Yeah.
So I think that's why they finally capitulate. They have been stronger. They're capitulating here. Home Depot.
They almost touched your December 2018 area.
Yep,
and
just missed it.
You'd have to go 125, 150 to go into the 2016 numbers.
Yeah, they came right into that December 18 low. So again, if this country shuts down and nobody's doing construction, they're going to get hit. And I'd wait on them. This is not a one I'd be rushing to buy right now. I think you have to wait for this to come out.
All right, last one up here is gold, and I thought gold was great when it broke above 1350, and then Tudor Jones was talking 1700, which is exactly where it went. And then, of course, I think people are viewing the sell-off as a deflationary event, and the dollar picked up steam, and that was about all she wrote. And then it came back down. Silver got hit much harder than the gold, but do you think it'll hold this lower area and have a future, or do you think it's a game set match?
Gold was where they were hiding in through the whole China thing, right? Mm-hmm. Every time we talked about the trade war, what was going on in China, gold went higher in February. Mm-hmm. And then all of a sudden they decided gold wasn't the place to be. And to your point, no inflation, no gold, huge drop here. I don't know. I've seen people calling for this to go over 2,000, which would be near 200. What I can tell you is it came in and held the bottom end of this consolidation fin and the breakout level here. In this 136, 135, 136 area.
Even 130 would be a number,
Yep. So it came in as holding in here. This market's weird, Jim. We've kind of disconnected. You remember TLT? It was screaming, and as stock market went down, bonds went up. Now they're moving both down together at the same time. This market has completely disconnected from everything. If you like gold, hold a little bit in your portfolio, but I wouldn't be screaming to buy it here. Not until it shows me something. And for me to show me something, it needs to reclaim this 147 area on the GLD.
Well, TLT, you might as well put up there because I think there's a big story there. Personally, for full disclosure, when we went up to that 180 area, I sold every bond I could possibly get a hold of, and just went to money fund, government money fund that be, and I think that 180 was a blow off, and I don't think you're going to see 180 again. But that's my feeling.
That was an incredible move up to there.
Oh yeah,
right.
I mean, you could feel the panic, and after so long of doing this, I could just feel like come on, 0.3 on the 10-year, I don't know I'm going to do any better than that, and so getting out of everything you could up there on that blow off was I thought a very good idea. In hindsight, it looks like a very good idea, but I also think it might be telling us something else. That blow off could have been the bottom of the bond market as far as yields are concerned, and yields could actually start rising, and people will be shocked. Well, and then the other thing is it could also bode well that the equities could be the next thing to spike down.
Look at the price action. Look at the drop the last couple of days, right? Look what's going on here. It's people are bailing out. People want yield, and that's the one thing I keep saying to people out there and my subscribers on my website is that when this is over, there's no place to go but back into the markets to make money. There's no yield in bonds.
Right.
They're going to come back.
Tina's going to be all over the place.
Yeah.
Except I will tell you one thing. They're looking for liquidity for the corporate bond market.
Yep. HYG is getting killed.
HYG is getting killed, and the spreads are at 800 or better. Historically, 800 or better is somewhat near the lower part, and then the investment grades at about 2 to 3. That's also a very good value. And I was saying, short-term 1-year paper, 1.5-year paper at 3.5 on major league banks, senior unsecured. Those are pretty juicy. So I think, if anything, people will be going into maybe some corporate debt markets, which will help for liquidity. But it doesn't seem like they're going to want too much of the treasury at 0.3.
Why? You're not getting paid to hold it.
No, that's what I'm saying. Yeah. I think the Fed also is going to be hesitant to go to negative yields, because if you could put up DB up there, which is Deutsche Bank, you get an idea of what can happen to your stock on banks if you go to negative yields.
Well, I mean, Jim, I think the market has loudly spoken, and they don't want negative rates. In fact, the market, we got the cut to zero on Sunday night, right? Emergency cut again. We got this additional money being pumped into QE, and the market dumped on it. Mm-hmm. It's not about the Fed here. And anybody that thinks this is about the Fed, it's not about the Fed. The Fed has done what it needs to do. It's about the administration stepping up at this point and calming this country and taking more robust means to get control of this. The quicker this gets over, the quicker we all move on. Mm-hmm. And they want to see how this country is going to help the individual, the small people, right? Not right. The people. How are they going to help people who are hurting? And they want to see. Honestly, we should just shut this country down for 2 weeks.
That would probably be the best. The other thing about the Fed, though, is that their balance sheet is about 20% of GDP before this thing happened, and yep. Europe is 40%, and Japan is way over 100. So we can expect that balance sheet to just explode, because they're going to fill in that gap between 20% of GDP and where the Europe and Japan is. And so rather than making the interest rates go down, because European loan demand has fallen off a cliff. You could give the loans away for free. They don't want the loans. Right. But what we do need, we need a bid. And the way you get a bid is you get the Fed in there, juicing up their balance sheet and creating a bid. And that's what they're doing now.
But, this is the new world we all live in, right? For the last 12 plus years, this is our world. The Fed controlled central banks. There'll be a pipe. We're going to pay for this eventually. But right now, what I like seeing is that the Fed is stepping in, doing everything they can. They're also scaring the markets.
Yeah. Well, they can't have this thing freezing up. They have to have people go to the ATM and the money's there. They have to, have people's money market accounts, not break the buck and all that kind of stuff. So yeah,
I agree. I'm surprised they haven't stepped in and stopped short sellers right now in this market.
Yeah.
I mean, the rest of the world has been doing it. Why don't we just say no more short selling for now? Take a week off. I don't think they should close the markets. Everybody talking about that, I think, is nuts, by the way.
No.
Because then you
better do the Hotel California. You can enter, but you can never leave. That type of thing. Yeah. Well, we're coming up to the top of the hour. Do you have any particular stocks that you're keen on? Is there anything you want to offer out so people can get a hold of you and find out more about what you can bring to the table?
Yeah, thanks, Jim. For me, again, when we come out of this, some of the names I'm really kind of focused on are names that have been better. I love the payment space. I love Square. It's gotten annihilated, but I love PayPal's been acting better. Visa, MasterCard. We've talked about Microsoft. We talked about Apple today. These are names I'd be looking to run into as we come out of this. I think Roku down into this 60 area is starting to get very attractive to me again after that big run to 178. So when you look at names, you have to look at everything and evaluate it differently. If you want to learn more about me, please visit my website, smartoptiontrading.com. This is what it looks like here. Come in. I do live trading alerts. I have a trade room. It's open all day long from 9 till 4. It's $25 for the first month, $100 every month thereafter. I put everything on Twitter. So you get live Twitter feed if you're not in the trading room. Everything gets posted live in the trading room, news, events, trades. Everything comes in one place. And by the way, I'm always teaching people how to trade. And sometimes that's some of the best thing you can get is somebody that sits there and will talk to you and tell you what they're seeing and why they're doing a trade and walk you through each step of it. So, Jim, I appreciate being on here with you. Always enjoy
You
these.
bet, Mike. And I would say, if anyone, everybody who's listening, this is a time where it might not be a bad idea to compare notes on what each person is doing as far as what is their focus list, where do they think there's going to be value as this thing unfolds, and finding out what Mike's focus list is would be a very good reason right off the bat to go on the website and get familiar with what he's doing. Okay, I'm Jim Kinney. People who want to hear what I've got to say, I have a weekly market update that I issue and I send out by email. Simply email optionprofessor@gmail.com. You could be put in the queue. We are at the top of the hour just about here, and so I'd like to thank Mike Pisani for being here. Again, do take advantage of what Mike did bring out there for you. So contact him on his website or through the email. And right now I'm going to shift it over to David Kosmitter to wrap it up. Thank you, everybody, for being here today.
All right, thanks, guys. Lots of great info. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast network. You can also go to TimingResearch.com to get access to the recording of this show or any of the past shows. This show will be up as soon as I can get it posted, and all the other ones are there available to access as well. So I just want to thank my guests again for today, Mike Pisani of smartoptiontrading.com and Jim, the Option Professor at optionprofessor.com. Thanks, everyone.
Thanks, David.
Thanks, David. Thanks, Jim. Have a good one. Everybody be safe. Stay healthy.